In this week's episode of the Stock Scores Market Minutes, I'm going to give you some insight into how to use stop loss orders. Then we will do the regular weekly market analysis. We'll do a search for some trading opportunities and then the trade of the week on ZIOP. All right, so let's talk about using stop loss orders. Of course, we want to limit our downside risk. As traders, we are never going to be right all of the time, and we should accept that fact and recognize, therefore, that it is important to limit the size of our losses when we are wrong. Stops must be placed at a point where the market has proven you wrong. Now, I think a good choice for this is to look at the chart and use previous support. We can base that on the last or the important inflection point. I'll show you this on a chart in just a moment. Now, an inflection point is where the stock started to go up. It's where it stopped going down and started to go up. And we want to give a little bit of extra room around that, especially with less liquid stocks. Let's take a look at a stock that had a nice abnormal break here. If we think about action candles, this would be the abnormal break that sort of gets me interested because it tells us that something is going on with this company. And that was a break from a pennant pattern. So at that point, we can put our stop loss order just below support. So that's basically where the stock stopped going down and started going up. Now along the way, this stock has made a couple of more breaks, and we'll talk about those as well. So here you had another little pennant break right there, and at that point, stop can be right there. And here we had a nice break, and at that point, stop can be right there. Now this tells us something important that we should keep in mind, particularly when we're using stops on a longer term time frame like a daily or weekly time frame. I find it is best to wait for the stock to close below the stop loss point rather than just hit it. And that means you should be checking your holdings on a nightly basis. And if the stock closed below support, then the next day sell it. And in this case, it went through support during the day, but it ended up closing above it, and so it was not actually a valid exit signal. And good thing, because the next day it had a gap up and continued the upward trend. So as a sort of a generalization, you want to put your support, your stop, just below the last inflection point low, but look for a close below that price on the daily or weekly time frame to give your exit. Now, if you're day trading, swing trading, I prefer to actually use a hard stop because you're using much tighter risk management rules when you're short-term trading, but for the longer-term trader, I think those are some good rules. All right, we'll jump right into the S&P 500 as I always do. We have here the upward trend line on the 60-minute time frame going back 30 days, and you can see that the market actually closed at an all-time high on Friday, breaking out there, and really, it's a bullish market. You can't argue with the upward trend. You got rising bottoms steadily over time, and we have a nice sort of summer rally, the market drifting higher, and therefore you have to remain bullish on the US market short term. Looking at the market longer term, you can see there those all-time highs. Of course, we broke out a few weeks ago, kind of going sideways since, and now we're starting to gather momentum again. And it looks to me like this is a market that should continue higher until the upward trend line gets broken. I remain bullish longer term. Looking at the Russell 2000, we actually had a little bit of life in the Russell 2000 this past week. It's been pretty dead for a while, but a little bit of solid price action with a bit of a pickup in volume. Of course, we still have resistance to deal with, and until we can break out through that, I wouldn't get too excited. But the good news is we've got that little downward trend line there that was broken, and so I think we move up toward the highs, we'll get stuck, and then hopefully be able to break out. Maybe the small caps can start to play catch up with the large. Onto the Canadian market. TSX really underperforming the US markets this past week. You can see the TSX is stuck in this sideways trading range. So I give this a neutral rating. It's really weighed down by weakness in oil, and there's been a bit of a pullback in the gold sector in the last little while. And so that's taken some of the excitement out of the Canadian market. Looking at the long-term chart, still healthy long-term. We are compressing in volatility here toward resistance. What we need though is the breakout, and then that can lead us into the next leg of the upward trend. I will get worried if we break this little upward trend line, and even more worried if we break down through that floor price of support that goes back a couple of months. Moving right along to the TSX Venture, it's been a dog market for a while, but it has actually been able to break that downward trend line, starting to build a rising bottom. And if we can get a break up from a rising bottom, then perhaps move back to those highs. Hasn't happened yet, but we're in sort of phase one of a turnaround in that downward trend, so keep an eye on that. We may see some strength start to materialize as we go into the fall. On to currencies, US dollar had another strong week, breaking through this resistance level. We've talked about that potential for a little while. Next stop is the really strong resistance right there. Not a considerable amount of upside until we hit that point, but still some upside, so let's keep an eye on that. I think the US dollar remains bullish, and until it breaks the upward trend, remain bullish on it. Canadian market, it broke its downward trend line a few weeks ago, and now we're starting to get a pullback, pretty typical. A typical reversal goes as follows. You break the downward trend line, you go sideways for a while, and then you try to break from a rising bottom. So for us to pull back here and then maybe come back up and just work through a process of sideways trading over the next few weeks, maybe even a few months, would not be unreasonable. It does seem like the downward slide in the Canadian dollar has stopped, but we haven't really started an upward move just yet. On to the interest rate analysis. Of course, we always look at the bond market for that. And you can see the bond market in an upward sloping channel. That means interest rates, I didn't draw that very well. That means interest rates are generally falling. If this goes up, interest rates go down. And right now, stuck in this range until we break the upward trend line. I remain bullish, but I would get a little bit sort of hesitant to chase the bond market higher if it starts to get to the top of the channel. Right now we're in the middle, and so it's just a nice upward trend for bonds. On to commodities. Gold, of course, has been very strong this year, in the last few months actually, not the whole year. We broke this little pullback here, started right there. We've had a nice run since. A little bit of hesitation, I would say, by the buyers, reasonable given how much this market has gained so far this year in the last 2 or 3 months. And I think maybe due for a little bit of a pullback, but not really any sign of one. I just suggest a little bit of caution rather than chasing the gold stocks higher, maybe wait for a pullback. On to oil, and it is in what we call a pennant pattern. You can see I can draw a line across the tops and bottoms. And what really is happening is volatility is diminishing. With each cycle up and down, you can see we're compressing in terms of the price range that the market is trading in. And that tells us that investors are gaining some confidence that this is the right price. The question is, what direction will it break out of the pennant? Does it break up, in which case we're going to move back to the highs, or does it break down, in which case we're going to retest those lows? I don't know until it breaks out. I would just expect that it's going to go sideways for a little while, and then you want to watch for that breakout, and that'll telegraph the next leg of the move. And finally, the fear chart. Of course, the VXX is an ETN that represents the VIX, which is the S&P 500 implied volatility of the futures contract, short term. And it is at a real low point, showing us that there's no fear. Now, one thing I want to make sure everyone understands, this is lower than this, but in terms of what it represents for the VIX, they're about the same. And that's because this ETN has time value decay, which means over time it just loses value. And that's because the ETN is always rolling over into new futures contracts, and there's just loss of value over time. So don't think that this is actually lower than this. They're actually probably the same point in terms of the VXX or the VIX index. But I make the point because it tells you the danger of holding something like this long term. Because if you're wrong, not only do you lose on the decline in the value of the underlying asset, but you're also losing that time value decay. And if you don't understand that, but you'd like to, just do a Google search for time value decay of leveraged ETFs or time value decay of ETNs, something like that. And there's people out there that go through the math to explain how that all works. So my ratings then, bullish on both time frames for US stocks. It is an increase because we started to resume the upward trend on the short-term chart. Canadian stocks, neutral on both time frames. Gold, bullish long-term, but neutral short-term. Does look like there's a bit of profit-taking happening. Oil, neutral long-term, and bearish short-term. US stocks move to new highs this week and continue in their summer rally. Canadian stocks are lagging the US, and they're really stuck inside that sideways trading range that I showed. Gold has pulled back into its trading range and is losing some of that upward momentum in the short term. Still looks okay, but it's just getting stuck right now. And oil is starting to weaken again. Be a little bit cautious with oil. Fear is relatively low. All right, so let's jump over to the Stock Scores Market Scan and run a scan and see if we can see anything interesting. I like to run the abnormal break scan on a daily basis. So I'm going to select abnormal breaks US, run the market scan. Now, usually when I do this, I show my charts in the gallery view. You can see right here, we've got gallery. This time I'm going to switch that to slideshow. If you want to see the charts in a larger format, select slideshow, and then you only look at one chart at a time, but you can see a much bigger version of it. And so, for example, this stock had a little jump in volume, a little jump in price. I don't like that it closed well off of its high on Friday, so I'd rate this kind of a 5.5 out of 10. The fact that it closed off of its highs tells me that people were selling into the strength from the morning, and I don't really like that. But we'll just continue along. We'll look at a few here. GNC Holdings, you can see it broke its downward trend. That's step one in a reversal. Step two is build the rising bottom, which it did for the last month or so. And step three is break up from a rising bottom. Now again, you can see that the tail is a little long. Don't love that. And the volume isn't considerably higher than normal. So I'd give this a 6 out of 10. So this is the kind of thing that you can learn how to do. It's something I teach in the different courses I do, how to read charts so that you can ultimately analyze a stock in 5 seconds or less. Here you've got a stock also trying to break from a rising bottom after breaking the downward trend line a couple of months ago. Again, volume not real strong, price action not real strong. I'll give that a 6 out of 10 as well. So I'll just continue to cycle through these, and if I see anything really interesting, actually let's go back to this one. I'll tell you the problem that I have. It made such a strong move on Friday, and by the way, I day traded this stock on Friday. It was a great day trader. But as a longer term trade, I think, okay, there's my entry price. We talked about putting stops just below your last inflection point low, which would be down there. Well, if we take that distance and extrapolate it up once and then twice, you can see that I'd have to be way up here to get 2-to-1 risk-reward ratio, which is, to me, the minimum that I would want if I was going to take a trade. Well, the problem is this stock is going to have strong resistance right here, which is less than 2-to-1, and therefore that's why I don't particularly like it. I do think this stock is likely to go higher, but the risk-reward ratio doesn't make a lot of sense to me. If it were to pull back a little bit and then start to go up, well, now my risk-reward ratio can get a lot better, but that hasn't happened yet, so something to keep an eye on, but I wouldn't do anything on it just yet. We'll go through a few more, see if we can find anything else of interest here. Click on the next button. And here we have XELA, again, long tail, don't love that. I'm going to go through a few stocks really fast. If I see anything that I like, I will stop. This is the kind of thing you might want to watch for. This broke its downward trend line on Thursday. See the spike in volume on Thursday as well? And that's set up for a decent trade. Your risk-reward ratio, again, not great on that because you go 1, 2, and you're going to hit resistance right here. So it's just barely got that 2-to-1 risk-reward ratio. But on Thursday, it was okay. Let's call it a 6.5 out of 10. But to take it today after Friday's trading, well, now your risk-reward ratio is really offside because you're not even going to get 1 RR up to resistance. So today, it's down to a 4. And that's just 1 day's difference. Same stock, everything's the same. Only thing that changed is the risk-reward profile. All right, let's get back into the presentation and look at the day trade of the week. And this week, I want to show you ZIOP, which is a stock that triggered my action candle about 6 minutes into the trading day on Friday. And what caused that action candle? Well, abnormal price action, which tells us that buyers are acting aggressively, and the volume was higher than it had been for some time. And that tells us again that the buyers are getting aggressive. I don't know anything about this stock. I just run algorithms. The algorithm says, here's an opportunity, buy it. For $100 of risk, you would require 1,420 shares, which is $8,222 in capital. Divide that by 3 if you're using margin. That gives you a capital required of $2,740. And with that $100 risk, because it made a 5.7 RR, that's where it was right here, that represents a $570 gain. Okay, knock off commissions, maybe it's $550, but still you're looking at about a 20% return for a 1-day hold. That's the kind of day trades I love, making that quick return, simply following an algorithm that identifies abnormal activity. You want to learn more about that algorithm and how you can utilize it, go take a look at the trader training area in the Stock Scores website. There's some videos in there that will help you. All right, well, that has been the end of the market minutes for July 29th, 2019. Hope that you're having a great summer. Hope that you have a great week in the market next week. Remember to click on the like button, subscribe to the channel, and most importantly, trade well.